$94, that's where silver was trading. Everything looked bullish, war tensions rising, oil pushing higher, the Chinese demand climbing, analysts on TV saying silver could explode any day. And then, in just minutes, it dropped like a rock. 94, 92, 90, 88, a $10 wipeout in hours. No warning, no mercy. The question is simple. Who did this and why? If you want to understand what really moves markets, not the headlines, but the hidden hands, make sure you hit like and subscribe right now, because on Past and Profit, we break down the stories behind the money. And today's story is one you won't hear explained this way anywhere else. Let's slow it down. The world backdrop was perfect for silver to go up. Global conflicts were escalating. Whenever war fears rise, investors look for safe assets. Gold usually gets the spotlight, but silver moves with gold, and sometimes even faster. Oil prices were climbing too, and higher oil often signals inflation pressure. Silver historically performs well during inflation. On top of that, China's industrial demand was strong. Silver is not just a shiny metal. It's used in solar panels, electronics, electric vehicles, and medical equipment. When China buys more, it usually supports higher prices. So the narrative was clear: upward pressure everywhere. But markets don't move on narratives alone. They move on positioning, leverage, liquidity, and sometimes pure power. When silver touched 94, a lot of traders were already heavily long. That means they had bet big that prices would continue rising. Many of them were using leverage. Leverage is borrowed money. And borrowed money can amplify gains, but it can also destroy you fast. If the price moves against a leveraged trader even a little, brokers start demanding more cash. If the trader can't provide it, positions get forced closed. That forced selling pushes the price down further, and that triggers more forced selling. It becomes a chain reaction. So one possibility is simple. The market was overcrowded. Too many bulls, too much leverage. All it takes in that situation is one big sell order to tip the first domino. And when that domino falls, the rest follow quickly. Now let's talk about one big sell order. In commodity markets like silver, large institutions dominate volume. Hedge funds, banks, commodity trading firms. These players can move massive amounts in seconds. If a major fund decided to lock in profits near 94, they could unload thousands of contracts in a very short window. That sudden surge of supply can overwhelm buyers. Algorithms see the drop and start selling automatically. High-frequency trading systems kick in. Stop losses from retail traders get triggered. Within minutes, what looked like a healthy market turns into a waterfall. Another factor most people ignore is the futures market structure. Silver trades heavily on futures exchanges. Most of the trading isn't physical metal changing hands, it's contracts, paper silver. The amount of paper silver traded daily can be many times larger than the actual physical supply. So when price drops in futures, it doesn't mean truckloads of silver bars are suddenly flooding the market. It often means traders are adjusting positions rapidly. And because futures are leveraged by nature, the moves can be violent. But here's where it gets interesting. Whenever silver drops sharply despite bullish news, some investors immediately cry manipulation. They believe large banks suppress silver prices intentionally. There have been real cases in the past where banks were fined for spoofing precious metals markets. Spoofing means placing large fake orders to create the illusion of supply or demand, then canceling them after moving the price. That history makes people suspicious whenever a sudden drop happens. However, not every crash is a conspiracy. Sometimes it's just positioning. If everyone is already on one side of the boat tips easily. Think about it. If silver had already rallied hard from lower levels, many traders were sitting on big profits. As price neared 94, some funds might have decided it was time to cash out before the weekend, before a major economic report, or before central bank comments. When big money makes a profit, it doesn't send you a polite email first. There's also the dollar factor. Silver is priced in US dollars. If the dollar strengthens quickly, commodities often fall. A sudden spike in the dollar index can pressure metals even if the broader story looks bullish. Maybe a strong economic data release hit at the same time. Maybe bond yields jumped. Higher yields can make non-interest bearing assets like silver less attractive in the short term. Markets react fast to those shifts. And let's not forget liquidity. Sometimes price drops are exaggerated because liquidity is thin. If the drop happened during lower volume hours like overnight trading, fewer buyers might have been available. In thin conditions, even moderate selling can push prices sharply lower. Once regular trading hours open, volatility can expand dramatically. There's also a psychological layer. Round numbers matter. 95, 90, 85. Traders place stop losses around obvious levels. When silver slipped below 92, it may have triggered clusters of stop orders sitting just under support. Those stops become market sell orders. That pushes the price to 90. More stops trigger. Suddenly 88 prints on the screen. It feels dramatic, but it's often mechanical. Still, the speed of a $10 drop grabs attention. Retail investors watching their screens feel panic. Social media explodes. People start asking who's behind it. Was it a central bank? A major hedge fund? A coordinated move? In reality, markets don't need a villain to fall. They just need imbalance. Think back to other commodity spikes and crashes. Oil has done it. Natural gas has done it. Even gold has seen flash crashes. In highly leveraged markets, moves can compress weeks of price action into hours. That's the nature of modern trading. Algorithms react faster than human emotion can process. Now here's the deeper lesson. The news said war, oil, China demand, so silver should go up. But markets often move opposite to what feels logical in the short term. Why? Because price is not just about fundamentals, it's about expectations. If traders already expected higher demand and war risk, that optimism was already priced in at 94. When everyone believes something, there are no new buyers left to push it further. All that remains are sellers waiting for a reason. Imagine a crowded theater where everyone is standing near the exit because they expect a fire alarm. If someone shouts, "Smoke," people rush out instantly. That's what leveraged markets look like when they are overcrowded. So who dropped silver from 94 to 88? It may not have been a single mastermind. It could have been a combination of profit-taking by large funds, algorithmic selling, stop-loss cascades, dollar strength, rising yields, and over-leveraged traders getting forced out. The market structure itself can create violent swings. But here's the part most investors miss. Sharp drops don't automatically mean the long-term story is broken. Sometimes they reset the market. They shake out weak hands. They reduce leverage. After forced liquidations clear out, price can stabilize and even resume its trend. Other times, the drop signals that the rally was built on fragile foundations. This is where experience matters. Instead of asking only, who did this? A better question is, what does this tell us? Does open interest fall sharply after the drop? That suggests positions were flushed out. Does physical demand remain strong? Are ETFs seeing inflows or outflows? Are central banks adjusting policy? These clues matter more than chasing a villain. If you're a long-term investor, volatility like this should be expected. Silver is historically more volatile than gold. It has industrial demand and investment demand mixed together. That dual nature makes it swing harder in both directions. If you're trading with leverage, though, moves like this can wipe you out fast. And let's be honest, markets today are dominated by speed. High-frequency traders can execute thousands of trades in milliseconds. Large funds use complex strategies that hedge across currencies, bonds, and commodities. A shift in one asset class can ripple into silver almost instantly. The idea that price should move slowly and logically is outdated. There's also the possibility of margin adjustments. If exchanges raise margin requirements, traders need more capital to hold positions. Some will reduce exposure. That selling pressure can amplify declines. We've seen this happen before in precious metals. What makes this drop fascinating is the contrast between story and price. The story screamed bullish. The price screamed something else. That tension is where opportunities and risks are born. On Past and Profit, we focus on understanding that tension. Because if you rely only on headlines, you'll always feel confused when price moves the other way. But if you understand positioning, leverage, liquidity, and psychology, sudden drops start to make more sense. Let me ask you something. If silver had jumped from 94 to 104 in hours, would people ask who pumped it? Probably not. They would say the market is strong, but when it drops, we look for a culprit. That tells you more about human nature than about markets. The truth is, markets are a battlefield of capital. Every trade has a buyer and a seller. And when price falls fast, it means sellers were more aggressive than buyers at that moment. It doesn't automatically mean corruption. It means imbalance. Still, that doesn't mean manipulation never happens. History proves that some players have tried to bend markets. But building an investment strategy on conspiracy thinking can be dangerous. It takes power away from you. Understanding risk management gives power back. So, what should investors watch next? First, whether silver can reclaim key levels quickly. A strong rebound suggests the drop was a flush. Second, watch the dollar and bond yields. Third, monitor global demand signals, especially from China. And finally, watch sentiment. Extreme fear after a sharp drop can sometimes set up strong rebounds. The bigger lesson is about discipline. If you're investing in volatile assets, you need position sizing that lets you sleep at night. You need a plan before you enter. Where will you take profit? Where will you cut the loss? Because when the price is falling $10 an hour, emotions will not help you decide. As we wrap this up, think about the bigger picture. Markets are not designed to move in straight lines. They are designed to test conviction. They shake out weak hands, they punish overconfidence, and they reward patience and preparation. So who did this? Maybe a hedge fund locking profits, maybe algorithms cascading through stop losses, maybe a stronger dollar, maybe all of the above. The more important question is, what will you do next time volatility hits? If you found this breakdown helpful, make sure you comment below and tell me what you think caused the drop. Was it pure market mechanics or something bigger behind the scenes? Your thoughts matter, and I read the comments. Share this video with anyone who thinks markets only move on headlines, because this is a lesson everyone investing in silver needs to hear. And if you're new here, remember to subscribe to Past in Profit so you don't miss the next deep dive into the stories that move your money. Markets will keep surprising people. The goal is to be prepared, not shocked.